My name is Miranda Chook, a CPA. Banks have the same required financial statements as other commercial entities that sell tangible products, such as the balance sheet, the income statement, cash flow statement, and statement of shareholders' equity. However, since banks are in the business of taking deposits and making loans, you'll see categories such as loans on the balance sheet instead of inventory. And on the liability side, instead of large accounts payable balance, you'll see deposits, both interest-bearing and non-interest-bearing. Now, banks are part of the country's financial system, so they have a funding system that is specific to them. So since banks have access to different instruments than commercial entities do, what you'll see on their balance sheet differs quite a lot. And on the asset side, if banks have excess cash to invest, you'll see federal funds sold and securities under agreements to resell. And on the liability side, you'll see federal funds purchased and repurchase agreements as well. Now, on the cash flow statement, you'll see the categories, of course, in investing activities of gross loans made and loans that matured. On the cash flow statement, you'll see changes in the accounts just mentioned, and of course you'll see changes in the loan balance on the investing side, in the investing activities side of the cash flow statement. On the financing section, you'll see the changes in deposits. On the income statement, where you would see the gross profit margin on a commercial entity's income statement, you'll see net interest margin on a bank's financial statement. And the net interest margin is the excess of net interest income that's earned on principally loans, less the interest paid on deposits, and the result is net interest margin. And finally, for purposes of this segment, another significant item that is different from other commercial entities on a bank's income statement will be the provision for loan and lease losses.